This analysis explores the fundamental underpinnings of Kinross's current market position, specifically its asset-level performance, the structural integrity of its balance sheet, and a valuation framework. Operational review and asset-level performance. The operational foundation of Kinross Gold Corporation is currently defined by a stable production base that prioritizes quality and margin over absolute volume. In the third quarter of 2025, the corporation reported attributable gold equivalent production of 503,862 ounces, which represents a calculated decrease from the 564,106 ounces produced in the third quarter of 2024. This reduction was anticipated and integrated into the broader life of mine sequencing plans, reflecting a transition in ore grades and mining phases across several key assets, rather than a systemic decline in productivity. For the first 9 months of 2025, the company achieved total attributable production of 1,528,524 ounces, placing it in a robust position to reach the midpoint of its annual guidance of 2 million gold equivalent ounces. Cost management remains a primary driver of the operational narrative. The attributable production cost of sales was reported at $1,145 per gold equivalent ounce in the third quarter of 2025, an increase from $980 per ounce in the prior year period. This upward movement in costs is primarily attributable to the realized impacts of higher royalty obligations, which are mathematically linked to higher realized gold prices, as well as shifts in the production mix. The all-in sustaining cost, or AISC, on an attributable basis stood at $1,622 per gold equivalent ounce for the third quarter of 2025, compared to $1,350 in the third quarter of 2024. This metric was influenced not only by production costs, but also by the timing of sustaining capital expenditures across the global portfolio.
At the core of the portfolio are two Tier 1 assets, Paracatu and Tasiast, which typically account for more than half of the company's total production and a significant portion of its cash flow. Paracatu in Brazil production profile. In the third quarter of 2025, Paracatu produced 150,000 ounces, maintaining consistency with the prior quarter while benefiting from a decrease in production cost of sales to $933 per ounce. The operation continues to leverage its massive scale and efficient mill throughput, with a primary focus on high recoveries and grade optimization. Paracatu is currently on a trajectory to deliver near 600,000 ounces for the full year, marking its 8th consecutive year of meeting or exceeding this threshold. The asset's life of mine, LOM, extends well into the next decade, providing long-term operational stability. The Tasiast operation in Mauritania remains the highest margin asset within the Kinross portfolio. During the third quarter of 2025, Tasiast delivered 121,000 ounces at a production cost of sales of $889 per ounce. The performance at Tasiast is a direct result of the successful implementation of the 24K expansion project, which has optimized mill throughput and improved the overall cost structure of the mine. The asset continues to exhibit strong operational reliability, with high mill availability and recovery rates that consistently track above historical averages. The operation's LOM also extends into the 2030s, and it continues to track towards beating its annual guidance through optimized mill performance and high recovery rates.
United States portfolio, Alaska and Nevada. The company's Alaskan operations at Fort Knox have been transformed by the integration of the Manh Choh project, in which Kinross holds a 70% interest. Manh Choh provides a high-grade ore feed that has significantly increased production and cash flow at Fort Knox since its commencement in late 2024. In Nevada, Round Mountain is currently transitioning between mining phases. Following the completion of mining at Phase W, the site has commenced initial production from the Phase S open pit, which is expected to ramp up through 2026. Bald Mountain continues to focus on its satellite opportunities, with mining at the Redbird 1 pit advancing on schedule and study work for Redbird 2 ongoing to support future output. La Coipa, Chile. La Coipa has demonstrated significant recovery throughout 2025 as operations transitioned into the higher-grade ore of Phase 7. Despite managing groundwater challenges earlier in the year, the site remains on track to meet its full-year guidance, contributing to the company's overall margin expansion. Cash flow analysis. The cash flow generation capacity of Kinross Gold Corporation has reached record levels in the 2025 fiscal year, driven by the combination of high realized prices and disciplined cost containment. In the third quarter of 2025, the company generated $1,024.9 million in net cash flow provided by operating activities, representing a 40% increase compared to the $733.5 million generated in the third quarter of 2024. This increase in operating cash flow is even more significant when viewed on an adjusted basis, which excludes changes in working capital. Attributable adjusted operating cash flow for the third quarter was $845.2 million, up 35% from $625.0 million in the same period of 2024.
The company's ability to convert operating cash flow into free cash flow is a defining characteristic of its current financial health. Kinross reported a record attributable free cash flow of $686.6 million in the third quarter of 2025, contributing to a year-to-date total of over $1.7 billion. The free cash flow generated in the first 9 months of 2025 represents an 88% increase over the $905.8 million generated in the same period of 2024. This massive expansion in free cash flow has been achieved despite an increase in capital expenditures. Total capital expenditures in the third quarter of 2025 were $312.2 million, with attributable capital expenditures at $307.6 million. The split between sustaining and growth capital was relatively balanced, reflecting the company's dual focus on maintaining current operations while funding its high-grade development pipeline. The robustness of the free cash flow profile is further emphasized by the management's ability to exceed historical margin performance. Margins increased by 54% to $2,310 per gold equivalent ounce sold in the third quarter of 2025, significantly outpacing the 40% rise in the average realized gold price, which was $3,460 per ounce. This phenomenon illustrates the high degree of operational leverage within the business model. Once fixed costs are covered, a disproportionate amount of each incremental dollar of revenue is converted into free cash flow.
Looking ahead, analysts have forecasted a full-year 2025 free cash flow nearing $1.98 billion, a figure that signals a high level of financial flexibility. This liquidity has enabled Kinross to implement a robust capital allocation framework. In April 2025, the company reactivated its share buyback program, initially committing to a $500 million minimum return. However, following the record performance in the first 3 quarters, the company increased its 2025 share buyback target by 20% to $600 million. To date, Kinross has repurchased approximately $405 million in shares. Combined with its quarterly dividend, the company has returned approximately $515 million in capital to shareholders as of November 2025, with a plan to exceed $750 million in total returns by year-end. The quarterly dividend was also increased by 17% to $0.035 per common share, amounting to $0.14 on an annualized basis. The company also received a significant cash injection of $136 million in the third quarter from the prior divestiture of the Chirano mine in Ghana. This additional liquidity further bolsters the company's ability to fund its growth projects while simultaneously returning capital to shareholders and reducing debt. However, a potential headwind for cash flow in the first quarter of 2026 is an anticipated working capital reversal of approximately $400 million related to tax payments, a factor that has been clearly communicated to the market by the finance team.
Balance sheet analysis. The balance sheet of Kinross Gold Corporation has undergone a transformation, evolving from a position of strategic leverage to one of strong liquidity and conservative debt management. As of September 30, 2025, the company reported cash and cash equivalents of $1,721.7 million, a significant increase from the $611.5 million held at the end of 2024. Total liquidity stood at approximately $3.4 billion, which includes the cash balance and available room under the revolving credit facility. The most notable milestone in the company's recent financial history is the net cash position. As of the end of the third quarter of 2025, Kinross was in a net cash position of $485 million. With $1,721.7 million in cash and $1,236.9 million in total long-term debt, the company's net cash position reflects a highly disciplined approach to balance sheet management. This transition into a net cash state is a result of prioritized debt repayment throughout 2024 and 2025. The company repaid $800 million of debt during the 2024 fiscal year and cleared the remaining $200 million of a $1 billion term loan in February 2025.
The company's proactive debt management continued with the announcement on November 4, 2025, that it would early redeem all of its outstanding 4.50% senior notes due in 2027, which totaled $500 million. Following this redemption, on December 4, 2025, Kinross was left with $750 million in aggregate principal amount of senior notes outstanding. The remaining debt profile is characterized by long-term maturities with no near-term refinancing requirements, $500 million in 6.25% senior notes maturing on July 15, 2033, $250 million in 6.875% senior notes maturing on September 1, 2041. This optimized debt structure has contributed to a significantly lower debt-to-equity (DE) ratio than the industry average. As of late 2025, Kinross's DE ratio was 0.16, compared to the gold industry average of 0.36. This ratio is calculated using total long-term debt of $1,237 million, relative to total stockholders' equity of $7,957 million. The company's long-term debt to capitalization is estimated at just 5% to 13%, depending on the specific equity valuation used, placing it in the top tier of financial strength among senior gold producers. The improved financial profile has not gone unnoticed by credit rating agencies. In September 2025, S&P Global Ratings revised the company's outlook from stable to positive, affirming its BBB- rating. This was followed by a more significant move in December 2025, when Moody's Investor Service upgraded Kinross to a Baa2 rating, reflecting the company's sustained improvement in financial strength and operational reliability across its global asset base.
On the asset side of the balance sheet, inventories reached $1,381.2 million by September 30, 2025, up from $1,243.2 million at year-end 2024. This buildup primarily represents ore on leach pads and in stockpiles, which is consistent with the ramp-up of higher-grade projects like Manh Choh and the transition at Round Mountain. Current assets totaled $3,413.8 million against current liabilities of approximately $1,200 million, yielding a current ratio of 2.83 and a quick ratio of 1.68. These liquidity ratios indicate an exceptional ability to meet short-term obligations without relying on external financing. Valuation analysis. Kinross Gold Corporation trades at multiples that are modest relative to its cash flow generation and the underlying value of its asset base. The forward price-to-earnings (PE) ratio for Kinross is currently pegged at approximately 12.17x to 12.93x by various analyst consensus reports. This compares favorably to the company's 5-year average PE of 44.27x and its 9-year historical average of 47.76x. This historical discrepancy suggests that even with the recent price appreciation, the market has not yet fully priced in the structural improvements in the company's profitability and balance sheet. On a trailing 12-month basis, PE ratio stands at approximately 19.65x to 20.77x, which remains below the U.S. metals and mining industry average of 24.7x.
Benchmarking Kinross against its senior gold mining peers, while Agnico Eagle Mines, AAM, trades at a forward PE of 20.98x, Kinross offers a discount with more potential in the growth profile. The Zacks consensus estimate for Kinross's 2025 earnings implies year-over-year growth of 145.6%, compared to a projected 83.9% for Agnico Eagle. Furthermore, Kinross's return on equity, ROE, of 22.25% to 24.09% is substantially higher than the 13.8% recorded by Agnico Eagle, reflecting a more efficient utilization of shareholder funds. The enterprise value to EBITDA, EV to EBITDA multiple, which is widely considered the most relevant valuation metric for mining companies, also signals undervaluation. Kinross is currently trading at an EV to EBITDA of approximately 8.9 to 9.3x. This is lower than the industry median of 9.45x and significantly lower than the broader basic materials sector average of 14.36x. This gap is particularly noteworthy given that Kinross's free cash flow margin of approximately 21% to 38%, depending on the quarter and specific asset mix, is among the highest in its peer group. The price to free cash flow, P to FCF multiple, also shows value. Based on the 2025 free cash flow forecast of $1.98 billion and the current market capitalization, the company is trading at a forward P to FCF of approximately 17x. TM calculations place the P to FCF as low as 15.53x.
For a senior producer with a net cash position and a world-class growth project like Great Bear, this multiple appears conservative. The price-to-book P/B ratio of 2.68x also remains lower than Agnico Eagle's 2.94x.
Another key metric is the price-to-earnings growth, PEG ratio. Kinross's PEG ratio is recorded between 0.2x and 0.56x, a low figure that indicates the market is paying very little for the company's expected earnings growth. Typically, a PEG ratio below 1.0 is in general considered a signal of an undervalued stock. Intrinsic value models based on future cash flows, DCF, provide varied results. Some conservative models estimate a fair value for Kinross at $16.77, suggesting the stock is currently overvalued. However, other asset-based and earnings-based models, such as the Benjamin Graham Fair Value or Peter Lynch Fair Value, provide estimates as high as $126.10 to $176.40, highlighting the immense replacement value of the company's gold reserves and the potential for long-term earnings power in a high-price environment. Growth pipeline. The long-term value proposition of Kinross Gold Corporation is heavily weighted toward its internal growth pipeline, which is designed to replace current production with higher-grade, lower-cost ounces. The centerpiece of this strategy is the Great Bear project, located in the Red Lake mining district of Ontario. Since acquiring Great Bear Resources in February 2022, Kinross has rapidly advanced the asset through the exploration and permitting stages.
In September 2024, Kinross published a preliminary economic assessment, PEA, for the Great Bear project, which confirmed the asset's potential as a top-tier operation. The PEA outlines a high-grade combined open-pit and underground mine with an initial life of approximately 12 years. The project is expected to produce over 500,000 ounces per year at an AISC of approximately $800 per ounce during the first 8 years of operation. The production cost of sales is projected at $594 per ounce, which would make Great Bear one of the lowest-cost mines in the global gold industry. During 2025, the company focused on the Advanced Exploration (AEX) program at Great Bear. Key infrastructure, including the camp and a natural gas pipeline, has been completed and commissioned. Detailed engineering for the main project is advancing, and initial procurement activities for long lead items are scheduled to begin in 2026. Exploration drilling at Great Bear continues to expand the resource base, with 3 diamond drill rigs currently testing geophysical and lithological targets outside of the core LP, Hinge, and Limb areas. Results from the third quarter of 2025 have continued to demonstrate high-grade continuity at depth, with notable intercepts such as 56 meters at 5.8 grams per ton gold and 123 meters at 3.5 grams per ton gold. In Nevada, the Round Mountain Phase X project represents a significant opportunity to extend the life of one of the company's most important assets. Underground development at Phase X has advanced over 5,200 meters, and extensive drilling in both the upper and lower mineralized zones has returned strong widths and grades. Drilling highlights from Phase X include 65 meters at 4 grams per ton gold and 114 meters at 3.6 grams per ton gold. The technical team is currently progressing through studies and detailed engineering to support a final production decision for the project. Other growth stage projects include the Curlew Basin in Washington state, where infill drilling has shown high grades and mining widths that support the current resource estimate, and the Lobo Marte project in Chile.
At Lobo Marte, baseline studies are ongoing to support the environmental impact assessment, maintaining the company's option for a potentially long-life, low-cost mine in the Maricunga district. Lobo Marte represents a long-life, low-cost option for the 2030s, with a projected production start in 2031. The regional exploration program across the entire Kinross portfolio is backed by more than 50,000 meters of planned drilling for 2025, ensuring a steady stream of technical data to drive resource conversion and new discoveries. Risk assessment. While the financial position of Kinross Gold Corporation is historically strong, investors must consider a range of internal operational, financial, and jurisdictional risks that could impact future returns. Operational and project execution risks. The primary operational risk is the execution of the high-grade growth pipeline, specifically the Great Bear project in Ontario. Maintaining a stable 2 million ounce production profile into the 2030s is heavily dependent on Great Bear coming online as scheduled in 2029. Technical and permitting hurdles remain significant. Permitting complexities. The main project at Great Bear is subject to federal approval by the Impact Assessment Agency of Canada, or IAAC, with a project impact statement expected for filing in early 2026. Construction on the main project cannot begin until federal approval is secured, which is currently targeted for 2027. Additionally, provincial water-related permits are required for the exploration portal and decline.
Technical uncertainties. Development at Round Mountain Phase X and Curlew involve complex underground mining that requires consistent high-grade drill results to validate mine plans. Ore grade and strip variability across the portfolio can lead to fluctuations in quarterly output. Financial and market risks. Input cost inflation. The company faces persistent pressure from input costs, specifically energy and skilled labor shortages. Production cost of sales per ounce sold increased by 18% year-over-year in the third quarter of 2025, primarily due to mine sequencing and higher royalty obligations. Working capital volatility. In the first quarter of 2026, the company anticipates a major working capital reversal of approximately $400 million related to tax payments, which will temporarily impact free cash flow and liquidity. Currency exposure. The company operates with cost bases in Brazilian reals, Mauritanian uguia, and Chilean pesos, CLP, while revenue is in USD. Adverse fluctuations in these exchange rates can negatively impact unit cost structures. Jurisdictional and asset concentration risks. Kinross's production is highly concentrated in a small number of key assets, which increases its vulnerability to regional disruptions. EBITDA concentration. It is estimated that approximately 60% of Kinross's EBITDA is generated by just two mines, Tasiast and Paracatu. This concentration makes the company more vulnerable to potential disruptions at either of these sites compared to more diversified peers.
Jurisdictional risk profile. A significant portion of the company's production and value is located in Mauritania and Brazil, which are viewed as having higher jurisdictional risks than regions such as Canada or the United States. These risks include potential shifts in mining codes, resource nationalism, or evolving regulatory frameworks. Conclusion. The investment profile of Kinross Gold Corporation in early 2026 is that of a high-margin senior producer with a de-risked balance sheet. The company has navigated a period of intense debt reduction, moving from a multi-billion-dollar debt position a few years ago to a net cash position of nearly $500 million today. This has allowed for the implementation of a capital return framework, combining a growing dividend with a share buyback program. Operationally, the focus on margin over volume has yielded record-setting free cash flow, with over $1.7 billion generated in the first 9 months of 2025 alone. The asset base, anchored by the high-margin Tasiast mine and the massive scale of Paracatu, provides a stable foundation for the next wave of growth. That growth is clearly defined by the Great Bear project, which offers the potential for high-grade, low-cost production in a lower-risk mining jurisdiction. From a valuation standpoint, Kinross remains attractively priced despite its recent rally. Trading at forward PE and EV to EBITDA multiples that are below industry averages and historical norms, the company might be re-rated as the market recognizes the Great Bear asset and the sustainability of the current cash flow profile.